prospect of different asset classes change as market conditions change. To create stable returns over time requires asset managers to change the allocation to these asset classes. In certain cases, asset classes are sold outright, whereas in other scenarios, managers might be happy to continue owning a small percentage in an out-of-favor asset class. How do managers combine asset classes, and what are some of the rules which need to be adhered to? Let's get right into it. Gentlemen, welcome to the program. Thanks so much for joining us. All right, Kirby, I think let's start off with you. Let's look at the context and the historical context when it comes to asset allocation.
I suppose asset allocation and the mathematical and the quantitative approach to kind of doing asset allocation really comes from the 60s and the 70s. You know, before that, you can kind of think about asset allocation in the following way. Board of trustees would get together for public money in the US or anywhere else in the world, and they would sit around a table and they would have a discussion around what they believed the economy would do. They would have a discussion around what they believed potentially asset classes could do, and often the person that would carry a lot of weight would be the person that was right in the previous 12 months. So if you were right, for instance, at any about the equity performances, say for instance in the last 12 months, we would be listening a lot to you, and we would say, okay, fine, we had 50% in equities, but maybe we should have 60% in equities.
So based on past performance, essentially,
absolutely.
Is what was happening.
But the fact that equities maybe the next 12 months does minus 10 or minus 20, you know, is completely irrelevant, which is maybe something that Roland would have said. And that's why I think that, you know, when you look at combining asset classes, the methodologies on how to combine asset classes, finding more robust ways to do this, and without, like, you know, literally, relying on people's screams and shouts around a table, is something which really started in the 60s and the 70s.
Wouldn't you say that, Roland, it is about having a very strong view about where things would be headed from a macro perspective as well? We know that during the crisis, people should have been offloading equities as we started hitting new levels on the markets, and this didn't happen, and now we start looking at various methodologies in terms to have a strong view, and that will obviously impact asset allocation.
There are two types of fund management styles. The one is obviously the bottom-up kind of style. So those fund managers, and we've had some of them on the show, would not believe in doing the asset allocation explicitly. They would do it by picking the stocks that they firmly believe in are cheap stocks from a value perspective, and their asset allocation would be a consequence of their stock picking. The other way to do it is a much more top-down or direct way, explicit way to manage your risk exposures, and that would be to actively make a decision. We want to go overweight equities or bonds or property or gold or whatever the case might be. If you are top-down active, you have to have a view or an expectation of those asset classes, whereas bottom-up fund managers don't necessarily have a view. They just pick the stocks that they believe in are good stocks.
With regards to maximum allowance, according to the regulations in South Africa, what is the maximum percentage you can have exposure in terms of equities?
There's obviously the retail space and the institutional space, but generally your sort of Reg 28 kind of limit is most fund managers would probably go up to 70, but not more than 75% in equities. There are also offshore limits. You can't invest more than a certain percentage, 20 to 25%, whatever it is, internationally. But other than that, in terms of cash and bonds and inflation-linked bonds, which are very popular now, you're pretty flexible in terms of what you can do.
Okay, Kirby, we're talking about balanced funds here. So in terms of asset classes and asset allocation, what in your mind is an ultimately balanced fund? We always know that there's a big portion that is, of course, allocated to equities.
Yeah, but I mean, that's really the growth driver. And I suppose the issue is that if you're in South Africa, and in a South African context, we're very lucky in this market because we've always kind of gotten used to a market doing about 15% per annum, and that excludes dividends that you kind of can reinvest in specifically in the institutional space. And therefore, you know, when you contribute money towards equities, you're getting some form of risk premium back for that. You're getting a return for the risk that you're spending at the end of the day, which that hasn't been the case in the US. In the US over the last decade, you haven't had that at all. So the question is, and the question you asked is, so what is the most prudent asset allocation? Well, that all depends on what your objective is. What is it that you're trying to achieve at the end of the day?
Well, there are two things there. There's obviously the return and the risk component. So you will have a view on your expected returns. Now, typically, the way that people look at that is they use a risk premium kind of argument. So they say, on average, what can I expect from equities above cash? What can I expect from property above cash, the risk-free asset? The other way is to say, I don't care what happened historically. I want to care what's going to happen going forward, which is more of a forecasted view. But you've got to look at, I mean, what is a good balanced fund depends on how much risk you want to take, right? So typically there's low, medium, high risk, and everyone has to fall in one of those 3 buckets.
Yeah.
And that will determine to a large extent your strategic allocation, whether how much you have in cash versus equities on that risk.
Which you're talking about objectives. Are you looking at benchmarks? So your objective is to beat a benchmark. Is your objective to ensure that there's as little risk as possible within the fund? So there's various objectives that one could actually have.
Sure, and I mean, I think Ronald would disagree with me here. But, you know, for most investors, you know, I believe that most investors have to beat inflation plus something, because that's living cost plus a certain margin of return beyond that living cost. Now, if you take those 2 into consideration, you can extrapolate those numbers and you can immediately fit that into a risk profile. And you could potentially then have a look at what these returns, what the risk is that you need to assume and the returns that you need to generate for those. Now, the problem that you sit with that is that usually, in order to understand returns, you need to have a historical view on returns, and then you need to extrapolate the numbers going forward. So you need to have a view. You know, lo and behold, if you had a view in 08 or 07 and you said, well, markets are going to do average or just below average, and then they did like minus 40% in 08 and 09, you were in serious trouble, regardless of your, you know,
so you need to
regardless
have
of
a proactive view as opposed to a reactive view at
Yes.
the end of the day of the market. Do you think that we are getting it right, Kirby?
You know, it's a difficult question to answer. I think there are people getting it right, but there's a vast majority of managers who battle to do this. As a matter of fact, one of the schools of thought around asset allocation is that asset allocation doesn't work. Just keep the constant number of you know, whatever you allocate to an asset class in the beginning, just make sure that you allocate the same amount. So if that number is 50% and you've decided to own 50% in equities, always make sure that you own 50% in equities, because at least then you'll achieve inflation plus, let's assume, 4%.
Okay, and of course, yeah.
But you know, that's regardless of cycles, because there is a school of thought that says, well, you know, asset allocation doesn't really work. You know, don't do active asset allocation. The facts remain, though. You want to be good at asset allocation, you need to have a past view. You need to understand how these markets behave in the past. It's pointless thinking that the equity market is going to do 80% if it's always just done on average 15% per annum, unless there's a valuation argument for it. You need to have a future view for it. You need to have a correlation understanding. So you need to understand how different asset classes work together. And then you need to understand how risks kind of play themselves out. And you can combine those in any way that you want to, but those are the things that you need to understand in order to do asset allocation.
Okay, so Roland, give us your view with regards to the challenges and the mistakes that we've seen from South African asset managers in terms of combining asset classes. And I suppose when you look at the market turmoil and the intense volatility that we've been seeing, it's really tough to read where the markets could be headed. We know how they've behaved before, but we don't know what's going to happen going forward because of all the intervention that we're seeing from the developed market economies.
Look, when you are a balanced fund manager or a CPI manager, you are dealing in asset classes. Whether you want to admit it or not, you will have an exposure to equities, bonds and cash. Even if you don't believe in asset allocation, you have those exposures. And that's important when you say, you know, what kind of mistakes are there, or what are the risks in this process. A lot of fund managers don't understand the difference between a weighting in their fund and an exposure in their fund. So, for example, you could have no resources in your fund, so your weighting is 0, but you will have an exposure to resources because they are correlated to the market, and you are correlated to the market, so you are correlated to resources. So one needs to understand what's driving your portfolio, and often if you have 60% in equities, for example, as a weighting, actually equities explain 80% of the risk in your portfolio because they are so volatile. And it's that exposure that is much more important than the actual weighting. And that is called risk management or risk, you know, trying to find an asset allocation that gives you the risk you want rather than the weightings in the fund.
How does the notion of risk return, Kirby, affect techniques when it comes to asset allocation?
Well, you know, that depends how much of a mathematical manager the asset manager is, so how much maths does he actually use, or versus how much look and feel he looks. They could be quite different. Let me give you an example. Let me give you an example of this. Some people would use, for instance, efficiency and the efficient frontier, use Markovitch type methodology in order to combine different asset classes, and that's often a historical view. So they'd say, okay, let's reduce the one asset allocation. Say, for instance, you know, let's the expectation for a certain asset class slightly, combine them, and let's see what the outcome could be look like for the asset allocation. Other people, maybe a Pitfall Unit is a good example like this. Bottom up, he'd look at the market, say, I don't see any opportunity, don't buy anything. You know, don't worry about any mathematical model or anything. Let's just try and understand the market, and you know, if there's no opportunity, there's no opportunity. So those are very different methodologies, and that's why you see that asset allocations from fund to fund and from manager to manager changes, because not only are they different, but the methodologies and who they are completely different.
Yeah, what is your view with regards to having a target of CPI plus something down the line? Because we've had this debate before, and it's not really viewed as a benchmark. in a sense.
Yes, I mean, Kirby mentioned earlier on, sorry, that you have to, in order to make sure you retire wealthy, you need to have a return above inflation. And that means, that's what I call a target return or a required return. But when you're trying to understand if a manager's got skill, you can't compare them to a target return. You've got to compare them to a risk-adjusted benchmark. So there's nothing wrong with having a CPI plus 5 mandate, but you will not know if somebody's got skill or not, if they outperform that benchmark or not, because there are many portfolios of cash, bonds and equity that would outperform a CPI plus 3 or 5% return.
How did the crash of 2008 affect the notion of asset allocation?
I think it certainly highlighted that if you don't focus on these kind of things, that it would have a huge impact on you. What we saw in Europe is that it literally has changed the way asset managers think about portfolio construction, in the sense that if you, in a serious crisis, and you only pick stocks, which a lot of fund managers do, you can't adapt to those changing market conditions very easily, because getting in and out of stocks is very difficult because of the illiquidity or the size of your fund relative to how much you need to liquidate. Whereas if you are a top-down asset allocator, it's much easier to manage risk in a crisis. And you're literally seeing in Europe a lot more people wanting products that are top-down active than bottom-up active. And we haven't seen that yet in South Africa, because we haven't really been affected as much by that crisis, or at least the funds haven't seen that effect.
I want to show you guys an example of how asset allocations change. If you look at the graphic at the moment on your screen, you'll see, and I mean, Eleni, you've spoken about this, okay? You said you want to see an actual strategy, so here's one for you. It's called inflation plus 3 to 5%, and it shows you the changes in the various asset classes that are in this strategy. Now, I mean, it's quite a busy chart. And maybe what you want to do is you want to focus on the bottom bar, the very dark blue bar at the bottom. That's South African equities. Now, you can see at certain points, you know, it buys up to about 50% in South African shares to try and achieve a return of inflation plus 3 to 5%. You know, in the beginning parts,
30% actually.
Well, no, it's not lower than 30%.
2003.
Correct. It's not lower than 30%, but it can buy up to about 55% in equities. Now, the interesting thing over here is that if you go and look at the beginning portions or the end portions of 2006, we as a team start reducing asset allocation. So we start reducing equity exposure in the strategy. Equities are roaring ahead. Equities are doing fantastically well, but you're reducing the exposure to South African shares because markets are becoming more and more expensive. And the turning point is obviously in October 08 and in the beginning parts of January 09, when the market starts bottoming out. As a matter of fact, the bottom of the market was more kind of February 2009. And then you can start seeing us increasing the weighting towards South African shares, because now we are in essence buying cheap companies, and you know, we're able to now, for the risk that we're assuming is.
But I see offloading just a bit recently, right?
Yeah, absolutely, because markets obviously, you know, at a 15 PE. You know, markets aren't as cheap as what they were, and you potentially must understand that you can buy international equities at the same valuation that you can buy South African equities, and those are multinationals. So, but that gives an example. This is an active asset allocation fund. So there's limits to this, obviously, though. So we would never take equities and sell equities outright, because remember that the average client over here targets a return of inflation plus 4 for retirement fund purposes, or retirement purposes, I'd rather say.
Okay, so Roland, from a skill perspective, are you happy with what you see?
Well, I would want to ask Kirby whether the exposures, because this obviously just shows the weightings. One would have to look at the exposures of this to see, but it is quite a conservative fund in the sense that equities are quite lowly weighted. I don't know what the volatility is on this fund, but it's probably a lot less than the market.
Yeah, absolutely. Yeah, no, absolutely. Because I mean, also remember, this is a hybrid fund. So I mean, you've got some equities, some bonds, and I mean, there's a whole bunch of other asset classes that we try and include in order to try and reduce
We'll take a look
volatility.
at it in just a bit. We're going to a very short break. When we come back, we'll be taking a look at the Axis Inflation plus 3 to 5 fund strategy, of course. We'll see you right after the short break.